Hi there, welcome to Kneppy Invest. Time to talk Wesfarmers, one of the biggest companies in Australia in terms of how many people they do employ, 107,000 if I remember correctly, and there are about 500,000 shareholders of Wesfarmers. So maybe you are one of those who owns some shares in this company. Now, I would describe Wesfarmers as a diversified investment company. Now, they do own quite a few businesses, but by far the biggest business is Bunnings. They also own Kmart, Target, Officeworks. They own quite a few chemicals, energy, and fertilizers companies. They also own a lithium mining company. I'm not sure that's in production. It used to be owned by Kidman, and now what's it called? I forget what it's called, but it used to be owned by Kidman, which I was a shareholder of back about 5 or 6 years ago. They also own industrial and safety companies, and most of those sort of companies in their chemicals, energy, fertilizers, and industrial and safety companies I have never heard of before. So, a diversified investment company. They have spun out Coles a few years ago, so they were even more diversified. Now, one of the reasons they spun out Coles a few years ago was really to increase the margins. So supermarkets like Coles have really low margins, and just by spitting out Coles, they actually increase the margins by a fair bit. And we'll have a look at that later in the video. Would I classify Wesfarmers as a high or low quality company? I definitely would be trending towards high quality. This is a company that has been growing quite consistently over the past 10 years, maybe not at a great rate, but it definitely growing at a consistent rate. Probably my only concern with Wesfarmers is the valuation. And during these difficult times when the overall market is falling, although markets run up quite nicely over the past few months, a lot of people would transition to companies like Wesfarmers, Woolworths, Coles, because they do believe they are defensive stocks. So I do consider Wesfarmers to be a high quality company. And if it is a high quality company, that means when I look at Wesfarmers, it's all about the value. Do I see any value in Wesfarmers at current valuations? And the trend in the share price is of less importance. For full disclosure purposes, I am not a shareholder of Wesfarmers. However, just by looking at the chart, the daily chart, it is starting to look interesting for possibly a short-term or even medium-term trade, or maybe even a long-term trade if the share price moves into a long-term uptrend. I have never owned shares in Wesfarmers, and one of the reasons I have never owned shares in Wesfarmers is simply because they used to own Coles, and I have no interest in buying in supermarkets. No interest in buying in Woolworths, no interest in buying in Coles. The only one I might have a bit of interest would be Metcash, who own IGA, and that would only be if I see really good value. The only time I've thought about buying Woolworths was back in 2016 when the share price went below $20, if I remember correctly, and then the share price started to move up. And as soon as it moved up past about 25, I didn't see any value in that company at that point in time. So that was a fair while ago. If I see a share price of Wesfarmers for maybe about 20 to 30% from here, I might become interested in taking a position in this company. Now, although I have said that the value of a company of Wesfarmers is what I'm looking at, and the trend in the share price is of less importance, one thing I have noticed when you look at the long-term chart for Wesfarmers, and this goes back to March 2012, is there are periods when the share price of this company does absolutely nothing. In fact, there was a long period between 2013 and 2018, so almost a 6-year period, when the share price went sideways. So if you're a shareholder of this company during that period, you probably would have been absolutely frustrated. And then the share price broke out in 2018, and the share price doubled in about a 2.5 year period. The share price did reach a peak towards the later period of 2021, and that peak was around about $67. Share price has fallen a fair bit from that high back in 2021. Current share price is around about or just below $50, but the share price did reach $40 back in June when the overall market did reach its bottom. More probably shouldn't say it did reach its bottom because we don't know that just yet. There is still a chance the market could go down from here. But The main theme here, or main thing to really take away from this, is sometimes even these high quality companies, the share price can absolutely do nothing for a long period of time. So there is an argument that even for these high quality companies, trading them could be a good idea because there is an opportunity cost for holding Wesfarmers shares during the period between 2013 and 2018 when the share price of this company did absolutely nothing. You could have been owning a company that share price was in a well-defined uptrend, and you would have done much better in your portfolio returns if you did follow that sort of strategy. I've already gone through some of the companies that Wesfarmers do own, and Mount Holland, that's the Kidman lithium mine that they did acquire about 5-6 years ago. Bit of a disappointment because I was a shareholder of that company. 50% joint operator of that lithium project. So industrial and safety, supplier and distributor of maintenance, repair and operating products, manufacturer and marketing of industrial gases and equipment, and so on and so forth. Health, wholesaler and retailer, pharmaceutical, health, well-being and beauty products. I think that also includes Priceline, if I remember correctly. Yeah, API, Priceline Pharmacy, Clear Skincare, Soul Patterson Chemist, Club Premium, and Pharmacist Advice. If you go to their website, they do list all their websites. So they have Officeworks, Geeks to You. In their industrial safety, they have Blackwoods, NZ, which must be New Zealand Safety, Blackwoods, Corgas, and Workwear. So I've heard nothing about those companies. In their chemicals, energy, and fertilizers section, they also own CSBP, Australian Vinyls, AGA, QNP, Evol, LNG, Clean Heat, Modwood, and Covalent Lithium. Now, I'm more excited about what's happening in their chemicals, energy, and fertilizers, and I'll talk about why I'm more intrigued by that division when we look at their financial year 22 results. Also should mention they still have a stake or interest in Coles. That interest is 2.8%. In 2021, it was 4.9%. They also have a non-controlling interest in Westpine Industries and also a non-controlling interest in BWP Trust, which is Bunnings Property Trust. A non-controlling interest in Gresham Partners Group Limited. And in their One Digital section, they also have One Pass membership and One Data asset. So a lot going on for Wesfarmers, and that's why I would consider this company to be a diversified investment company. Onto the financial year 22 results for Wesfarmers at a share price of $47.86, which is the share price just before closing on the 8th of December. That gives a market cap of this company 54.3 billion, which probably would be, in terms of the ASX, one of the biggest companies on the ASX. I'm thinking maybe in the top 20, definitely top 50, maybe top 20, maybe even top 10. So this is one of the biggest companies in Australia in terms of valuation, in terms of employees, in terms of probably even, maybe not a turnover, $36.8 billion of revenue. Might be quite a bit lower than it used to be when this company did own Coles and before they spun it off. A profit of $2.35 billion. So if you compare the profit to the revenue, this company still has fairly low margins, but those margins have improved after they spun out Coles. Operating cash flow $1.3 billion. Now that's a little bit different than what Wesfarmers would have reported because I do minus leases, and this company does pay leases or have leases on their books. And free cash flow of $200 million. To go from operating cash flow to free cash flow, you minus capital expenditure. And this company spent about $1 to $1.1 billion on capital expenditure. Now onto the revenue growth. And unfortunately, when you look at many of the these sort of platforms, what do you call them? Websites where you get all the financial data from. So this is from this is from Ticker, TIKR. Also get information from Guru Focus. And unfortunately, when you look at the revenue here for Wesfarmers, there's a massive drop in 2018 from 64.9 billion to 26.7 billion. And that's because that's when they spun out Coles. But if you just look at what happened before they spun out Coles, you can see the revenue climbing at a nice, consistent, slow rate. And the same thing has happened since they spun out Coles. but the revenue has started to increase at a little bit greater rate than before they spun out Coles. So in fact, the last 4 years since they spun out Coles, the revenue has been growing at 8.5% per year, which is pretty nice for this type of company, for this size of company as well. The other thing I've included here is operating margins. Before they spun out Coles, the operating margins for Wesfarmers was below 6% quite consistently. And after they spun out Coles, the operating margins for this company is consistently above 9%. In fact, in 2021, operating margins for Wesfarmers was 10.6%. So that's one of the benefits for actually spinning out Coles is the increase in margins, the better margins that Wesfarmers have. Now on to how individual companies or individual divisions have performed for Wesfarmers, focusing on revenue here. I just want to see where most of the revenue is derived for Wesfarmers, and about 50% of revenue for Wesfarmers is from Bunnings. So that is maybe a little bit of surprise, but Bunnings has been a really phenomenal performer for Wesfarmers over the past decade, and it's still continuing. However, sales growth is around about 5% from financial year 21, which is still good for a company that is fairly large. $17.7 billion of revenue for Bunnings, and second half sales growth was actually 9.2%. Kmart and Target combined are not growing, total sales growth -4%. And one of the reasons behind that is because they did close down some Target stores. In fact, Target revenue dropped from 2.6 billion to 2.2 billion. And we know they did close down some stores because comparative sales growth actually rose 8.6% for Target. Officeworks revenue up 4.6% in financial year 22. Catch or GTV up 1.6%. So that's catch.com.au. And then industrial and safety up 3.8%. But look at Wesfarmers, what's that one called? Chemicals, energy, and fertilizers. Revenue increased from $2.1 billion to $3 billion, or an increase of 41.7%. That's why I'm intrigued by that part of the Wesfarmers company, that division, because of that really good growth. If they can continue growing I always have to look at it, chemicals, energy, and fertilizers over the next 5 to 10 years, that part of the business is going to become larger and larger part of Wesfarmers. And if they can continue to grow, that would be good news for Wesfarmers, the company, and also its shareholders. Now to the cash flow statement. In fact, we're going to look at the cash flow statement in this slide and then the balance sheet the next slide. The reason I wanted to look at the balance sheet is found right down the bottom, because at the start of financial year 22, Wesfarmers had $3 billion of cash on hand, and at the end of the financial year, they only had $705 million. So they lost about, maybe I shouldn't say lost, but the cash on hand actually fell by $2.3 billion during the financial year. So I just wanted to see why. Now, the operating cash flow, only $2.3 billion, which is significantly lower than last year, which was $3.4 billion. Now, in itself, that's not a concern necessarily, because there might be some changes in working capitals and stuff like that, which could put a significant dent in this year's operating cash flow. So when I say working or changes in working capital, I'm talking about increases in inventory. And we'll have a look at the balance sheet to see changes in working capital. You could also have a look at note 4, which is a reconciliation of cash flow to profit. Some other things to take note here is outflows in investing activities was $1.2 billion because of capital expenditure, which was $802 million. Payments for mine properties and development, $338 million. So Wesfarmers owns some mines, and miners have to develop their property. Also exploration, only $4,000 or was that $4 million in mining exploration, and $773 million in the acquisition of subsidiaries net of cash acquired. So when you take into account investing activities, the cash flow was around about $1.2 billion. Then we have to have a look at financing activities. So the proceeds of revolving facilities, $2 billion. So that is debt. Proceeds from borrowings, $938 million. Repayment of borrowings, $1.2 million. But the main thing here is this company has gone more into debt just based off that proceeds from revolving facilities. Principal component of lease payments, $1 billion. This is why I always want to include, personally, Why I want to include lease payments in operating cash flow, because it is a part of the day-to-day business for a company. And this company owns, well, they don't own, they rent a lot of stores around Australia, and they have to pay rent. And that amounted to $1 billion this year, $986 million last year. They also paid $1.9 billion in dividends and a $2.3 billion capital return. So combined, that's $4.1 billion they gave back to the shareholders. And that's one of the reasons why the cash on hand fell for this company. Not only did the cash on hand fell to fund these dividends and this capital return back to the shareholders, they went more into debt. So that is actually a red flag, in my opinion, that they went more into debt to give money back to their shareholders. And this is the balance sheet. So there's a few things I'm looking at here. And the first thing is I'm looking at changes in working capital, which is trade and other receivables, inventories, and trade and other payables. Inventories went up from 4.5 billion to 6.1 billion. So inventories increased by $1.6 billion. So Wesfarmers have built up their inventories over the past year. Trade and other receivables went from 1.2 billion to 2.1 billion. When you see trade and other receivables and inventories increase like that, that is a cash outflow. So that cash outflow amounted to about $2.3 billion. The other thing you have to take into account is trade and other payables. That actually increased by 1.1 billion, and that's actually cash inflow. So combined, working or changes in working capital was more than $1 billion. Now, another interesting thing when you look at the balance sheet is there has been a decrease in total equity from 9.7 billion to around about $8 billion. And one of the reasons behind that is because of an increase in borrowings. So if you look at the current liabilities, interest-bearing loans and borrowings went from 950 million to 988 million, so not much of an increase there. But in the non-current liabilities, interest-bearing loans and borrowings went from 2.1 billion to almost $4 billion. So this company has gone more into debt in the past year. And one of the reasons they've gone more into debt is to fund the increase in inventories and also to fund the dividend and the capital return back to the shareholders. So in terms of the health of the balance sheet, I will probably say that Wesfarmers' balance sheet is less healthy now than it was 1 year ago. Now on to the valuation metrics for Wesfarmers. And this is very important if you consider Wesfarmers to be a high quality company, and I too. P ratio 23.1, which may not sound too stretched. If this was a supermarket and that's it, 23.1 P ratio would be way too high. Woolworths right now is way too high, or the P ratio is way too high for a defensive stock, for a company that's not only going to grow their revenue and their profit like 2 to 3% per year. P ratio way too high for Woolworths. For Wesfarmers, because they are a little bit more diversified than Woolworths, I'll give them a little bit of leeway in terms of the P ratio. Price to sales ratio 1.5, which would be higher than, say, or Soul supermarkets. The price to sales ratio would be a little bit lower for those sort of companies. Price to operating cash flow, a lot higher, 41.8. So that's way too high for this company, in my opinion. And if you looked at the price to free cash flow, even higher than 41.8. And based off the operating cash flow for this company to justify the current valuation, they'll have to grow their operating cash flow at 24.5% per year. And I think that is a little bit too high, a little bit too much. I don't think this company would be able to achieve that unless their fertilizer, chemical, energy, and fertilizer division performs really well over the next 10 years. Now, although based on valuation metrics, I wouldn't be that excited about Wesfarmers, but there is one thing I am excited about Wesfarmers right now, and that is the daily chart. There is potential we might be seeing a developing uptrend for Wesfarmers' share price just based off this chart. This is a daily chart going back to August last year. I wanted to go back to August last year because that was a high in Wesfarmers' share price. And from that high all the way through to June this year, the share price did fall, and it fell quite appreciably from $67 down to $40. But we have seen sentiment starting to shift from negative to positive for Wesfarmers. Looks like the share price is wanting to move into an uptrend. It is trying. Now, the price that it has to get above is about $49, we'll say $49.50 or $50, because back in August, that was a high. And recently, in the past few weeks, the share price has really struggled to get above that level. That means around about 49.50 is a resistance level for Wesfarmers. So I want to see that resistance level broken. And if it can break, I would say the share price of Wesfarmers is looking, or maybe not confirming, but definitely looking like it is moving into an uptrend. And that was why I'm a little bit excited about Wesfarmers right now. I have put this on my watch list, and I'm just going to see how the share price responds over the next few weeks and see if the share price can get above $50. And if it does, I might take a short to medium term position in Wesfarmers, not a long term position, but just a short and medium term trading position, I suppose you could call it. I plan to continue doing this financial year 22 result series, and the next 5 companies I'll be looking at include LaserBond, Brambles, 9 Entertainment, SG Fleet, and Phoenix. Now, I am getting quite a few requests, so I will start doing videos on requests. So I just went through some of the comments, and there are quite a few requests there. So if you do have a company you'd like me to feature in one of these financial year 22 result videos, just leave that request in the comment section of this video. No guarantees I will do a video on that company, since I am getting quite a few requests, but I'll look at all companies that are requested and then pick, and maybe I'll do a system on how I pick and choose which companies to feature. That's all I have for this. So look at Wesfarmers financial year 22 results. If you have any questions about Wesfarmers, maybe any of their companies they have within this diversified investing company or any of their divisions, I'd love to hear from you. If you know more about their, I'm going to mess it up, chemicals, energy, and fertilizer division, I'd love to hear it. I'm always going to struggle naming that division, CEF. It's always chemicals, energy, and fertilizer there. I've remembered it about 3 times in a row now, so well done to me. So if you have anything you want to say, just leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.